You know that feeling when you get your paycheck, pay all your bills, and there's literally almost nothing left? You look at your bank account and think, what happened to all my money? You worked 40 hours a week, you were responsible, you didn't go crazy spending, and still, somehow, you're not getting ahead. Here's the thing. This is the single most common financial experience in America today. According to a 2023 Federal Reserve report, nearly 64% of Americans are living paycheck to paycheck. That means 6 out of every 10 people you pass on the street are in the exact same position as you. Now, here's where it gets interesting. The people who are not in that group, what are they doing differently? They're not necessarily making more money, they're not smarter, they didn't all go to Harvard Business School. The one thing most of them have in common is this: they put their money to work in the stock market. And I know what you might be thinking right now. The stock market, that's for rich people. That's for Wall Street guys in suits. But look, that's the exact mindset that keeps most people stuck. So today, I'm going to break the stock market down so simply that a 10-year-old could understand it. And by the end, you'll know exactly why it matters for your life. Okay, let's start with the most basic question. What is the stock market really? Imagine your neighbor's kid, little Emma, sets up a lemonade stand in the neighborhood, and she's making $50 a day. Business is booming, but Emma wants to expand. She wants to open 3 more stands across town, and that's going to cost her $500. She doesn't have $500, so she comes to you and says, "Hey, would you put in $50 and I'll give you 10% of my business?" You think about it. Emma's lemonade is delicious. People love it. The demand is real. So you say yes. Congratulations. You just bought stock. You are now a part owner of Emma's lemonade stand. You own 10% of everything. 10% of her profits, 10% of her growth, 10% of her future success. Now, scale that up. Instead of Emma's lemonade stand, think Apple, think Amazon, think Microsoft. These are massive companies with millions of customers and billions in revenue, and the stock market is the place where regular people like you can buy a piece of them. When you buy 1 share of Apple stock today, it costs roughly $170, but you own a tiny piece of one of the most valuable companies on earth. The stock market is not a casino. It is a marketplace where people buy and sell ownership stakes in real businesses that produce real products and services. Here's the most surprising part. Over the last 100 years, the US stock market has returned an average of about 10% per year. All right, now I want to show you some math that most people never sit down and actually work through, and it is going to change the way you think about money forever. Let's say you're 25 years old and you invest just $200 a month into a broad stock market index fund. Not $2,000 a month, not $20,000, just $200, which is roughly $6 to $7 a day. That's less than your daily coffee and lunch combined for most Americans. Now, at the historic average of 10% per year, by the time you reach 65, you would have approximately $1.2 million. You put in about $96,000 of your own money over 40 years, and the market turns it into $1.2 million. The extra $1.1 million? That came from something called compound interest, which Albert Einstein allegedly called the 8th wonder of the world. Compound interest means your money earns returns, and then those returns earn returns, and it just keeps snowballing. In year 1, your $2,400 earns $240 in returns, but by year 30, you're earning tens of thousands of dollars per year, even if you never increase your monthly investment. Most people don't realize this because nobody teaches it in school, and that's one of the most expensive gaps in our education system. Here's what's really wild. If you wait just 10 years to start until age 35 and do the exact same thing, you end up with around $480,000 instead of $1.2 million. Those 10 years cost you over $700,000. That's the real price of waiting. Now, you might be thinking, okay, this all sounds great, but what about crashes? What about 2008? What about losing everything? And that's a completely valid concern.
The stock market does go up and down, and those drops can feel scary. In 2008, the market crashed by about 50%. People's portfolios got cut in half overnight. In March 2020, when the pandemic hit, the market dropped 34% in just 5 weeks. These are real events, and they feel terrifying when you're living through them. But here is what most people fail to see. In every single case in the history of the US stock market, the market eventually recovered and went on to reach new all-time highs. After 2008, the market fully recovered by 2013, and then went on a decade-long bull run that made many investors extremely wealthy. After the March 2020 crash, the market hit new all-time highs just 5 months later. The people who lost money permanently were the ones who panicked and sold at the bottom, not the ones who stayed invested. Think of it this way. If your favorite grocery store put everything on a 50% sale, you wouldn't run away from the store, you'd buy more food. Market crashes are the stock market going on sale. The smart money buys during crashes, not sells. The psychological shift you need to make is this. Stop thinking of market losses as losses and start thinking of them as opportunities. You only lose money in the stock market if you sell while it's down. If you hold, history shows you almost certainly come back stronger. So, what do you actually do with all of this? Let me give you a concrete, simple action plan. Step 1. Open a brokerage account today. Not next week, not when things calm down, today. Platforms like Fidelity, Charles Schwab, or Vanguard are all free to open and have zero commission trading.
If you have access to a 401k through your job and your employer matches contributions, that is free money and you should absolutely be taking full advantage of it.
A typical employer match is 50 cents on every dollar you put in, up to 6% of your salary. That's an instant 50% return before the market even does anything. Step 2. Start with index funds, specifically something like the S&P 500 index fund, which tracks the 500 largest US companies all at once. Instead of trying to pick winning stocks, which even professional fund managers fail to do consistently, you just buy the whole market. Step 3. Automate your investments so you never have to think about it. Set up automatic transfers of whatever you can afford, even if it's just $50 or $100 a month, and let compound interest do the rest. Step 4. Don't touch it. Don't check it every day. Don't panic when it drops. The stock market rewards patience more than intelligence. The most successful investors are almost boring in how little they do. Warren Buffett, one of the greatest investors in history, has said his favorite holding period is forever. Here's your final thought. Every day you wait is a day your money isn't working for you. The stock market isn't for rich people. It isn't for Wall Street. It isn't complicated. It is simply the most powerful wealth-building tool ever created, and it is available to you right now, today. So, close this video, open that brokerage account, and start putting your money to work.